don't know either. I'll go talk to the former president and ask him how he does it. But here, dividend yield, percentage of account, gain loss ratio. I want to pull up Coca-Cola. Where are you, Coca-Cola?
Fifth from the top.
Fifth from the top. All right, so they are up 23%. And if I look at when we bought them, transactions.
Temporary unavailable.
What? I can't show people what we did? Yeah, we can. All right, so we're going to do all. Show me all, everything.
Search.
Yay, okay.
Dividend. Look at all those dividends.
So if you buy a stock and you hold it for a year, it becomes a long-term stock. That changes the taxes that you pay when you sell it. When Brian said, hey, you sell the stock, you pay taxes. I would be paying capital gains taxes on this, not ordinary income taxes. Now, if you need to check that with a tax person, please do so. I am not a tax person. I just pretty good with accounting because I run a business.
Yep.
And I have to do it every month. I pay taxes, I run payroll, I do all the bookkeeping. I am the guy behind the scenes making sure the ship doesn't hit a
iceberg.
Something. Making sure it doesn't sink.
So we bought that in 23. So
yeah,
we're
22
and 23.
Yep. So then we bought at 22 and then 23. So we're over the year for both of them. But take a look at this. Qualified dividend. See, qualified. That means better tax rate. In order for us to want to buy more, what we need to see is in that stock. Let's go look at them. Oh, they won't make me click on it. Fine. I'll go back here. So in that stock, we go to Coca-Cola, the Coca-Cola company. Yay. Did I pull up twice? All right, good. They grew 24% in the portfolio since 2022. Did their earnings and the market capitalization grow by the same amount? Now, you can just see the market capitalization by looking at this. And sure enough, they almost did. Market capitalization did not grow by 23%. However, 5 years, it most certainly did. It went up 53%. So that's 10%, just over 10% per year on top of their dividend check. That's pretty good. And they pay a 2.83% dividend check. So you made 13% per year if you bought Coca-Cola 5 years ago. That's pretty good. I've had personally Coca-Cola stock since 2007. Let's go back to 2007, see how you did back then. I thought I did great. Then I thought I did really bad. And then there was a split. And I think there's another split somewhere along the line, but I know there's two.
But just keep going up.
The dividend checks just kept coming. So when you buy a stock and you're buying it for income, you're trying to do it with like if we talked about the ETF taxes thing, you're trying to do it with the taxes in mind. You might want to drip those dividends, but at the same time, if you do it as a long-term investment, look how well this company has treated you for having some faith in them. All the woke stuff aside, they have done very well and they've treated me very well. So I'm very thankful. Thank you, Coca-Cola. I am sorry I cannot drink most of your drinks because there's too much sugar in them.
But Market Edge hates it. Avoid.
They do. And I think the reason for that is, let's go to the year-to-date. Yeah, year-to-date, they're up 15%. And then 1 year, so the 52-week averages are pretty close to their high. And Market Edge is pretty technical with the way they do things. So that makes sense to me. As far as like Coca-Cola, we're up 23%. Dividend, if you look at the dividend payout ratio and the yield, you can see very consistent.
Here?
5%. Yeah, it's very consistent. Now, the coverage ratio is not great. The payout ratio is a little high. Don't like seeing that. However, we looked at these guys a month ago. It looked a lot different. So you would have to see their financial reports to dig into that. What I want to see is revenue growth that exceeds the 23% that we've had for the past, was it 2022? Was it December, January?
2022. I can't remember.
Yeah, well, so I have to look at annual here. And then let's go to total assets, 87 to 100. So that's more than 23%. The debt liabilities, we go from 67 to 75. So their assets grew by more than their liabilities. Their global footprint grew. We know that because we look at their earnings reports, which is good. Look at their earnings, and we want to go 2022. So 43. So it's only 10% total revenue. However, their operating income, we want to go to the net income and see if that grew. Now, there are a lot more metrics than just this to look at if you're looking at buying a company. But just for a quick glance, because we already own them, 2022, they were at $9.5 billion, and they went to 10.6. So they grew about 10%. So they did not grow by more financially as a business than what their market capitalization has grown by. So if you're a fundamentals guy, that's something to pay attention to. Are we going to sell the stock? Well, we have to find one that actually will outperform it. Now, remember, too, we're getting qualified dividends on these guys. So if we buy something else, sure, I pay capital gains rates. I don't pay income rates. But whatever we buy, we switch right back to ordinary dividends.
Yeah, we have to wait a year.
You got to wait a year, and then you got to wait the 60 days before the X date to even get it. So there's not a lot of incentive to sell the stock. So there you go, Coca-Cola. Same thing with AT&T. AT&T is in the same space. So Campbell Soup, another one that we've owned for a while. I think, let me go back to them on the portfolio, see when we bought these guys. Campbell Soup was on our list. Stop.
Fourth from the bottom.
Oh, that's right. These guys are not doing too good for us, at least comparatively, which is a good time to buy. Transactions, Campbell Soup. So if anybody thinks we're not legit, here's some proof that we are, because you can go to our YouTube channel and you can see all these monthly purchases. Dividend, qualified, $20, $7, all the way back. So 2023, September of 2023. So we could probably do that quarterly, I think, for these guys. Let's go do that. Let's go look at them. Campbell Soup, checking them out. By the way, for all you people on X, if you know how to get us promoted there, please tell us. We don't know what we're doing. we kind of know YouTube, but we don't know X and Rumble, and we notice that that's growing quite fast compared to other platforms. So we're interested in working with them more. Here's Campbell Soup. 1 year, 52 weeks trailing. We have they're at their low. You're looking at a PE ratio. That means they're pretty cheap. 3 years. They're also low. God, we bought them at their high. How stupid was that? Actually, no, we didn't.
We didn't.
We bought them here. So not terrible. All right, so 5 year.
At the time, they were going down. They're still going down.
They're still going down. What's wrong with goldfish? Doesn't anybody like goldfish?
They went up after we bought it.
They did.
But now they're going back down.
That's why we're looking at buying them. And if we look at the short interest on these guys, it's high. 7%. She's pretty high. Market edge says nay. So this might be a good thing. Mm-hmm. Technicals say no. Let's look at year to date.
Argus says buy. Morningstar says buy.
Argus is kind of balanced. Morningstar is, we can look at that if people want, but 15% year to date, qualified dividends. Let's look at their earnings. Let's make sure that they're able to pay these things. 4.3%. Oh, and you can see very consistent growth again on their dividends. This goes all the way back to 2015, which is amazing. Thank you, Campbell Soup. And I still eat your goldfish. So you have one customer, and it's not just because I have kids.
I don't eat your goldfish.
Not yet.
I eat other things.
Payout ratio 87%. Oh, that's pretty high.
Yeah, both of them are.
Coverage ratio pretty low. Yeah, they've been repositioning. They bought Rayos. Am I saying that right?
Yeah.
Yeah. So they bought them, and that added their debt to them. So let's see how that panned out. It's still lower than 100% of their earnings, and it's still, they're still able to cover it. What I'd be a little bit worried about is their ability to increase their dividend, because that's really tight. You might get 1 penny pay raise.
That's an increase.
We increased it 1 penny. I think
1% is still an increase.
They do that so they can stay on the dividend aristocrat list.
Yeah.
It's like, well, we're still in it. All right, so income statement, we're going to skip the assets and liabilities, at least for now. We're going to go to quarterly because it was 2023 that we bought them. Their expenses are... Now, be careful with quarterly numbers, because when you look at, sometimes cash flow statements are produced annually, and some things with liabilities. It depends on the business. It depends on when their fiscal year ends as well. Operating expenses is increased by about 10%. Net income is down. We are down. That's expected, though, because of the purchase. Let's look at their cash flow. You can see in here their dividends. Are they buying back stock? So issuing stock means they're diluting their share. The parentheses means retirement, meaning they're buying back shares, and they are doing it. However, they're issuing short-term debt by 10 times the amount. So that's not exactly a good thing. So this company, there's some red flags here for the purchase right now. Would I sell them? I'm not sure I would. This is quarterly. If you look at annually, you pull them out annually, and you look at the net change in cash, 680, 790, so that's negative. Pull that up, positive. So they've lost some cash.
Well, look at the short-term debt reduction.
Overall, yeah. Overall, that's not necessarily a bad thing.
Versus the issued.
Campbell Soup has been struggling because our generation doesn't like a lot of salt in their food, so they've been trying to rebrand with that. They still have a pretty big market share, and in bad environments, people tend to eat cans of soup instead of going out to eat all the time, or something cheap anyways. Maybe it's PB&J, who knows, but as far as the business goes, I see they're still having, it looks like they're still having troubles just trying to adjust. Now, with that said, in their defense, look at the total revenue. We went from, I can't read that.
8.6 billion.
8.69. Yeah, okay. So
9.6 billion.
so they're increasing the revenue year over year. And I guess the operating expenses are probably going to go up by, if not more than
Pretty flat.
the same flat. Yeah. So 7.5 to 8.6. Operating income is about flat. So they're able. So here's the good news for Campbell's. They're able to retool essentially, and with them retooling, they're able to still stay basically stagnant. Like their growth is like Intel has a bigger problem because they have this big foundry thing. They've been trying to build it, and it keeps getting delayed, and they're losing market share and $4 billion of losses. Now this comes as somebody we have 10% of our portfolio in Intel. We've been buying the dip, the big dip, the canyon.
It keeps dipping.
It keeps dipping. But and they're like Campbell's have been able to do this without affecting their finances too negatively. So when I sell them, it's really hard for me to give up those qualified dividends. I don't like waiting a whole year to get that box checked. So would I buy them? I'm going to wait another quarter. I think we should wait. I think we should. I'm not answering because I think we should wait.
Yep.
All right, so we're going to wait on these.